Hello everybody, welcome to my final business finance presentation. Start with an executive summary. So in this simulation, we were given $100,000 each as investment managers, and our clients expected us to invest wisely and profitably while also maintaining low risk. This is our table of contents. This is everything we're going to be going into throughout the slides. And with that being said, we'll start with the economic analysis. So the trade deficit in the US has decreased by $8 billion, which theoretically means that the US dollar should be worth more, and that should signal to investors that there will be economic growth. However, this is kind of the opposite right now due to a bunch of tariffs. Along with this, there's a 0.8% increase in income and a 0.9% increase in disposable income. So people should be spending more, and this should lead companies' revenues to be higher, which means stocks should be higher. For our external analysis on the legal factors, there was a Corporate Transparency Act that was put into place, and essentially what this means is large and small businesses need to file a report with the government, and it prevents things like terrorism and money laundering. For our political factors, I'm obviously going to be talking about some of the tariffs. So Trump has a philosophy that tariffs are good for the country, and unfortunately businesses and the stock market do not like uncertainty. So there has been increased volatility, and there has been some big sector specific impacts, especially with technology and manufacturing, along with, I think, raw materials as well. So obviously the market didn't have a good reaction to this, and what happened was during the dip, there's the least amount of buys that probably has happened in a while. This is my favorite part. This is the investment strategy. This is the 6 factors. I got this from a book called The Intelligent Investor by Benjamin Graham. So essentially what this is when you buy stock, the company that you're buying shares from should follow these 6 principles. So the first is over 2 billion in annual revenue. Current assets should be double of current liabilities, which is basically just the current ratio. Long-term debt is less than working capital. The company has had positive earnings for the past decade, and EPS has been increasing by 3% annual. And finally, there is the price to earnings ratio should be 15. However, the author of this book wrote this a while ago, so he probably didn't see companies like Apple that had a price to earnings ratio of 25. So what this does is it basically means that a company can pay off debts if they are at risk of bankrupting, and it also means that companies' service or products are always needed. This is another investment strategy that I use. This is for diversification. So this was a book I read in about grade 11. It's called I Will Teach You to Be Rich by Ramit Sethi. And in the book, in the later chapters, there is a model called the Swenson model. And essentially this aims to maximize returns while minimizing risk. And it kind of tells you where you should have your money invested in the stock market. I didn't follow this model exactly. However, I did try to do some diversification through minimum buys. So for each of my stocks, I would try to buy $2,000 to $3,000 and kind of spread my money throughout the stock market. These are my best and worst performing stocks. So as you can see, Exxon and Chevron did pretty good, and they matched my 6 principles, which is good to see. For companies like Nvidia, Amazon, and Costco, they actually didn't do so well, and I bought them for diversification reasons as well as psychological reasons, so that's quite unfortunate. So did my strategy work? I started with $100,000. I ended up with $95,000, and that means I lost $5,000. Therefore, strategy didn't work. There are some possible reasons why. So when we started, we were forced to buy in the first couple of weeks there, and this is when the market was at an all-time high. A lot as well as this, tariffs didn't really help my case. It kind of crashed a lot of stocks. And then, as well as this, some of my stocks were bought for diversification. However, they didn't match my 6 principles. And stocks that I did buy for diversification didn't match the Swenson model. So maybe you'd argue that I should have followed that one more closely. For my appendices, these are all the stocks that I bought. For the reason I was buying, a lot of these stocks were compared to my 6 factors at first, and then everything else was for diversification and psychological reasons like ETFs, Costco, and Nvidia. And then for selling, I didn't actually sell a whole lot, and my philosophy is generally to buy low and sell high, as well as I'm not really a short-term investor, and I would probably invest in the long term for probably years and years to come. So in conclusion, if I wasn't forced to buy immediately, I'd probably wait for the crash, especially for those tariff announcements, as well as I should have followed the Swenson model for proper diversification. And then finally, psychological reasons get in the way of objective decision making, which didn't really help for some of my stock choices. As well, if I were to do it over again, I'd probably have put some more money into call and put options. I learned that later into the course, and that actually could have saved me a lot of money. But yeah, I hope you guys enjoyed. I'll see you next one. Peace.